Okay, in the previous video we were talking about the assumptions and now principles, and we discussed the revenue recognition principle, which is also part of the matching principle, that revenue is recognized basically when earned. Okay, the matching principle includes the revenue recognition and also expense recognition. So when do we recognize it? Or remember, recognize means put it into the books, record. Okay, when do we record or recognize expenses? So the expenses should be matched with the revenues whenever it is reasonable and practical to do so. We recognize expenses when incurred. That's when we owe them, when we get the bill, okay? And when they match the revenues they help to create. So what that means is that we want to put February utilities expense, which is our expense, we want to match that against February sales. So if I didn't have the lights on in the store in February, no one would come in and buy stuff. And so we wouldn't have any February sales. So we want to make sure on the February income statement that the February sales, and then we subtract the February utilities, regardless of whether we prepaid those utilities in January or we're not going to pay the February utility bill until March. We don't care. When we're paying that bill, we want to record that bill in February against the February sales. We want to match the expenses of a particular period to that same period of the revenues they help to create. Now this thing on the bottom shows different types of costs, and we've talked about these in Accounting 102, the product costs, materials, labor, and overhead, and these have a direct relationship between the cost and the revenue. These are the exact costs of the products, and then we sell the products for higher price to the customer than what these costs are. And so the ones that the costs of the ones that are sold go in an account called cost of goods sold. That's an expense account, and it's matched against the sales of those exact same products. And so we have a direct relationship, okay? Those expenses are attached directly to the sales that they are part of. And so we recognize in the period of revenue, okay? Very easy to do. We're going to show the cost of those things that were sold. We're going to be able to subtract those right from the sales of the things that were sold and get a gross profit for that particular period. All the material, labor, and overhead of the stuff that isn't sold is still left in the inventory account. Work in process, finished goods, materials, whatever, these are left in those inventory accounts, which goes on the balance sheet. Okay, we're not actually showing them as an expense until we sell them. And then there's a direct relationship, and they get put onto the income statement. Period cost means they just happened within that period. So salaries or other administrative costs, we paid those in February. And maybe some of those employees worked in January, or were paying for salaries, some kind of prepayment of salaries, whatever. It doesn't, matter. We're paying the salaries and stuff that happened in that particular period of the month of February. So there's no direct relationship between that salary cost and the sales that we made in February. It doesn't exactly attach itself the way these do here. But we expense these, and we show these an expense as they're incurred, as we get the bill. And that goes in there like that and called a period cost or period expense. The full disclosure principle, and this is kind of buried in one of those other characteristics that we already talked about, the completeness characteristic, included full disclosure. And that means providing the information that's of sufficient importance to influence the judgment, and we want all of it there. And we are going to provide that. We're going to disclose all that information. Some of it will be on the financial statements. Some of it will be in the notes to the financial statements. And we also have a thing called supplementary information that can be attached to the financial statements. So this way, we need to make sure that every piece of information that might be helpful to an investor or creditor should be somewhere in these documents here that we give them. Okay, so here is another one of these where we're going to take a look at some examples. Okay, so Norfolk Southern Corporation reports revenue in its income statement when it is earned instead of when the cash is collected. So that's part, of course, of the revenue recognition principle. Yahoo Inc. recognizes depreciation expense for a machine over the 2-year period during which that machine helps the company earn revenue. So that's part of the matching principle, where we're including an expense, depreciation expense, that we're matching to the revenue. So in other words, I didn't take the whole cost of the equipment and just subtract it the year that I bought it. I'm spreading out the cost of that equipment across all the years that I'm going to get benefit out of that equipment. So in this case, they're getting benefit for 2 years, so we're going to take some of the depreciation in the first year and the rest in the second year and match those against the revenues that we receive, that we earned those 2 years. The third one, Oracle Corporation reports information about pending lawsuits in the notes to its financial statements. Okay, and here is the full disclosure principle. And again, we talked about lawsuits back when we talked about completeness. Eastman Kodak Company reports land on its balance sheet at the amount paid to acquire it, even though the estimated fair market value is greater. So that land is now worth a large amount of money, okay? However, on the balance sheet, because of the historical cost principle, we have to show that land at what we originally paid for it. Now, the full disclosure principle, however, says that somewhere in the notes to the financial statements, we probably should say something about that piece of land and that it's now worth X number of dollars. Okay, and we got now to the constraints. Again, I didn't include the materiality constraint because we did already fully talk about that. We have the cost-benefit constraint, which still is on the current framework, the industry practice constraint, and the conservatism constraint. So the cost-benefit says that the cost of providing the information must be weighed against the benefits that can be derived from using it. Okay, and so every time we want to collect how much does something cost, that's going to take some amount of effort and time and wages paid to certain employees, and so it's costly to get these things together that are required on the financial statements. So if it's some piece of information that really isn't going to do much for anybody, okay, then instead of providing that information that's going to cost us a huge amount to get, we just won't provide that piece of information. Even though it might be useful, if the cost of providing it is so outweighs what benefit we do get. Now, if the benefit is huge, then we're just going to have to pay the cost regardless. Okay, but if it's only a tiny benefit the investors would receive from using that information and the cost to us is huge to provide it, then that is a constraint, and we will be allowed by GAAP to not have to do that. Industry practice. The peculiar nature of some industries and business concerns sometimes requires departure from basic accounting theory. So farms, for instance, and the way that crops are recorded as costs and revenues of crops is different from the way that we would do, say, some factory products that are made or from merchandiser stuff. So that is a separate industry practice that they have done things a certain way for a zillion years, and so they have a different GAAP. Okay, so FASB has a different whole set of rules for doing that particular industry. Conservatism constraint. This is when you're in doubt, choose the solution that will be least likely to overstate assets and income. So in other words, if we've got a couple of different options of how to do something, then the option that would show our assets being worth more than they really are, or that our sales or income being more than it really is, we should not choose that option. Now, if there was an option where it might show assets or income being lower than it really is, well, we can do that, okay? But being conservative means we never want to overstate stuff, because then investors and creditors jump on that, and, oh yeah, we're going to invest, and then all of a sudden, oops, you know, and then it's all our fault because we put these overinflated numbers. So no matter what, we want to make sure that we don't overstate assets and income. So here again, we've got some little exercise here. Zips Farms reports agricultural crops on its balance sheet at market value instead of at what it costs them. Well, that's an industry practice for farm crops. Crimson Tide Corporation does not accrue a contingent lawsuit gain of $650,000. So contingent means that it might happen. So they're in a lawsuit. They think they're going to win the lawsuit and that they're going to get $650,000, but it hasn't happened yet. We haven't got it, so we're not going to put that on the financial statements. We might talk about the fact that we're in this lawsuit and that we kind of feel we're going to win it, you know, but we are not going to put that on the financial statements, okay, that's a receivable or anything like that, because it hasn't happened yet and things might turn around at the last minute. All of a sudden we lose the lawsuit, okay? So we want to be conservative. We don't want to overstate income or assets. Okay, Wildcat Company does not disclose any information in the notes to the financial statements unless the value of the information to users exceeds the expense of gathering it, and that, of course, is the cost-benefit constraint, which is still in place in the current framework.